Well, good afternoon and welcome to the September 2023 Superannuation update. So today, basically, we're going to be covering off what's been happening in the last few months, sort of around super, important things just to bear in mind, and also some issues that are still active and bubbling around and carrying on, so to speak. So they're my details. If you have any questions about this webinar, please by all means reach out to me, and I will be more than happy to answer them for you. Important disclaimer, basically, while I've been doing this a long time and you can believe what I say, it doesn't mean that legally you can believe what I say. So if you need personal advice, then please reach out. So as I mentioned, we're going to touch on some important reminders just around threshold updates and the like. We'll touch on the transfer balance caps, first home super saver scheme, NALA-E and NALI, and I'll explain the differences between those when we get there. Just a tax alert around property development, some information around deductibility of personal super, which will actually lead into a couple of court cases that have been around recently. One is on deductibility of personal super contributions. It wouldn't be a webinar that I'd give without it actually having some statistics on what's going on in the industry. And I thought, lastly, given it's a bit of a burning topic for a lot of people, I'd briefly touch on the $3 million proposed tax that's meant to be coming up from 2025. So some important reminders. So firstly, minimum pensions for account-based pensions, the 50% reduction that we've had on the minimum pensions for the last couple of years no longer applies anymore. So we're back to the normal percentages, if you like, which range between 4% up to 11%, depending on your age. If you want to follow the bouncing ball and actually have a look at what those percentages are, you can actually find them in the Superannuation Industry Supervision Regulations under Schedule 7 is where you'll find them. So this is from 1 July 23, so for the 24 financial year that relates to. Safe harbour interest rates for anyone doing a limited recourse borrowing arrangement where they are using themselves or a related party as the lender. Those interest rates have gone up significantly from last year, as has normal lending. Remembering that those interest rates are actually based on an RBA benchmark. And so if you're complying with the Practical Compliance Guide 2016/5 for any of those type of related party arrangements, then the interest rates that you required to repay now are 8.85% for property and 10.85% for shares. So obviously that's pretty steep, but that's sort of what the benchmark is. T-bar reporting, so your transfer balance account reporting. So from 1 July 2023, all transfer balance cap events to be reported 28 days following the end of the quarter in which the event has occurred. So in other words, if someone starts a pension today, being the 13th of September, that has to be reported by the 28th of October. So 28 days after the quarter in which it's happened. Additionally, all unreported events which happened before the 30th of September this year must be reported by the 28th of October. So up until this financial year, we had an ability to actually defer, if you like, the reporting of transfer balance cap events, depending on the size of the fund. So if the member balance was under $1 million, you could do it you only had to do it annually. Sorry, you didn't have to do it quarterly. Whereas now, all super funds are having to do report quarterly, self-managed funds that is. APRA regulated funds, they have to report 10 days after the actual event. So I think once this has been bedded down for a little bit, so for perhaps 5 years, I think that self-managed super funds will also move to a tighter time frame, whether it be after the month. I don't think it will get quite as tight as what the APRA funds are, but who knows, maybe we will one day. Penalty unit value increases. Hopefully you won't have to know these, but for things like even late lodgements, or if you're hit with administrative penalties by the ATO for perhaps not doing something, and there might have been in-house asset breaches or the like inside the fund, then there's points that are awaited to those discretions, and basically you're now paying $313 a point. So some of those indiscretions can be over 1,000 points. So it gets rather expensive rather quickly if you don't do the right thing. So always best to ensure you do. And finally, on this one, rollovers for SuperStream. So from 1 July 2023, all self-managed super funds must have an ESA, which is an electronic service address, to execute rollovers via the SuperStream arrangement. So in a nutshell, SuperStream is the electronic communication between super funds. So in this case, if there's a rollover, the self-managed fund may request money from an APRA regulated fund, and that's done by, depending on what software you use or your ESA, filling out the details, hitting the go button. That electronic message is sent to the other super fund. They will then run through their validity checks and so forth. Perhaps you needed to provide them a bank statement as well, which is quite common. And then they will send you a note back saying, yes, we've approved this rollover, and then the money will typically flow the next day. So that whole scheme is basically compulsory now for all self-managed super funds from 1 July 2023. And the auditor is required to report any breach of that. So if a rollover hasn't happened via SuperStream, they're required to report it, even if the self-managed fund is the reporting fund. And they also, there's also timeframes around these sort of things. So if a member wishes to leave a self-managed super fund, the SuperStream notice is received by the self-managed fund from the other fund. The self-managed fund has 3 days in which to effect the payment. So to essentially make sure it's valid and then make payment. If it's not within 3 days, then once again, that's a breach under the payment standards. So it's a little bit tricky when you've got typically accountants and trustees both having to interact here, but it's an important area that needs to happen to make sure that things happen smoothly. Just transfer balance cap. Really, what I want to talk about here is the proportional indexation of the transfer balance cap. So what do I mean by that? Basically, you may be aware that the transfer balance cap increased from $1.7 to $1.9 million from 1 July 2023. Well, what that means is if you had already started an income stream pension before 1 July 2023, you're assessed under the old or the previous cap. Let's say it was $1.7 million cap. Now, you don't automatically get the $200,000 increase from 1.7 to 1.9 for your cap. You actually get a proportion of it. And the way that proportion is worked out is what they call your highest ever transfer balance account balance. So let's say that we started a pension on $1 million, and that's all we've reported. So $1 million, and we then divide that by the transfer balance cap when we reported, let's call it 1.7 million. So $1 million divided by 1.7 and as a percentage, and then you take that away from 100. So that basically tells you what you haven't used. And then that becomes your unused cap percentage. That unused cap percentage is then multiplied by the $200,000 increase. So you don't get the full, you might get 60% in the example that we were using. So that's sort of roughly how it works. But having said all that, the ATO does actually calculate it for you, and it is published up on their either on MyGov or the Online Services for Agents site. So remembering that that will only show what's been reported. So if you started a pension, call it 1 July, but that hasn't been reported yet because you don't have to, then the information that the ATO has won't be right because they don't know that the pension has been commenced. So that's just something to bear in mind, that there can be timing differences or timing lags, if you like, in reporting, simply because the reporting hasn't occurred. Now, in an ideal world, when a pension is commenced, for argument's sake, it should be reported pretty much straight away, and therefore the ATO systems will be accurate. And just there's a little side note, for the ATO to calculate the proportional transfer balance cap for everyone, they basically did that between 1 July and 11 July. So there was a period there where it wouldn't have been updated, but from now on, it'll be accurate so long as the information they have is accurate, which is always the caveat, I suppose. First Home Super Saver Scheme. So basically, there's been some improved flexibility that's been brought into this system. So the First Home Super Saver Scheme allows you to withdraw up to $50,000 of voluntary contributions, including earnings less tax, from your super fund to assist with the purchase of a new home, and it has to be for a new home. And obviously, it's your first home too. Now, the maximum you're allowed to contribute to the scheme is $15,000 per annum. And basically, the changes that they've made via the amending the law, so Treasury Law Amendment 2023, measure number 3, an individual is now allowed to amend or revoke their application to release money from the ATO. Now, previously, you couldn't amend or revoke it. So once you put it in, that was it, you're locked in. So they've allowed that a little bit more flexibility. And also, you now have 90 days between submitting the release authority to the tax office and actually entering into a contract. Previously, that was 14 days. So they've given a bit more time to basically go through the contract process once you put in the request. It also gives the ATO more time, I suppose, so they can process the application. So yeah, so nothing major, but just little tweaks around the edges on that one. So now to talk about NAL-E. Now, NAL-E is non-arm's length expenses. So basically, back in about 2018, there was a legislative change that sparked interest in some people, a lot of advisors basically, and those in the industry, because it effectively meant that any expenses incurred by the super fund, if not at arm's length, cause problems for the taxability of the fund, essentially meaning top marginal tax rate. So the ATO and Treasury have had a few goes at clarifying this, to the point where in the last budget they announced changes, and these changes have now been put through as draft legislation, noting that it's still only draft. So we haven't actually seen it, hasn't passed Parliament. Basically, all they've done is throw it out to the industry and said, this is what we're thinking of, give us some feedback. Now, they're obviously still going through that feedback because the legislation hasn't actually reached Parliament as yet. So what does it really mean? So Treasury Laws Amendment Measures for Consultation Bill. So non-arm's length income expense rules for superannuation funds. So this only applies to self-managed funds and what we call SAFs, so small APRA funds. That's where they're like a self-managed fund, but the trustees are not the members. They're a larger institution like Perpetual or Australian Unity or something like that. So basically, the NALI arising from the NALI, so in other words, the non-arm's length income, which is the tax provision, arises from a non-arm's length expense at twice the shortfall amount. So in other words, let's say that you're an accountant and you were doing your own financials and tax return using your firm's software and subscriptions, tax agent license, that sort of thing. Now, if the firm didn't charge you for that, then, and you didn't, and obviously as a trustee, you can't charge, then that is what's called a non-arm's length expense. You should have paid, say, $2,000 for that. You haven't paid that. You've paid zero. So what this draft legislation is essentially saying is that $2,000 is multiplied by 2, and then you pay tax at the top marginal tax rate of 45% on that $4,000. So, which essentially comes back to roughly what the expense is that you have that you didn't pay. So NALI income and expenses is taxed at 45% top marginal tax rate. So basically what they're trying to do is remove the incentive not to charge arm's length expenses, and obviously same with income. And we'll come back to income in a minute. Now, it also excludes contributions under this calculation, which is great. And also expenditure that was incurred before 1 July 2018 is excluded under this, or exempt, I should say, under this draft legislation. And as I mentioned, APRA funds are also excluded. Now, it's important to note that the ATO's Administrative Practice, PCG 2020/5, no longer applies from 30 June 2023. So what that PCG or Practice Compliance Guide suggested was that if you had non-arm's length expenses, you could essentially ignore them, because while they were going through and trying to find a solution out to the various ebbs and flows that this has been through over the last 5 years. So basically, that no longer applies. So right now, if there are NALI expenses, then the entire income of the fund is taxed at top marginal tax rate on all income. So certainly something to be very conscious of, particularly at the moment until we have this draft legislation finalised and through Parliament, and hopefully it will go back to 1 July 2023 as far as the enforcement date or the application date. So just something to bear in mind there around NALI expenses. It's a real tricky area because it depends on if you're fulfilling the role of a trustee or as a professional, as to whether those expenses are actually treated as non-arm's length expenses or not. So if you have some skills, education or training in a particular area, the chances are that NALI would apply if you don't charge. So, and it doesn't matter what it is. It could be a tradie making improvements to a property. It could be a lawyer doing their own conveyancing. So the idea is they're trying to have absolutely everything on an arm's length basis. And the reason for that is that if the fund isn't incurring the expenses, then essentially it's getting the benefit, which means that your balances would be otherwise higher than what they in theory should be. So if those balances are higher, potentially it's a way to avoid contribution caps, as well as other sorts of caps. So that's why there's an importance on it, I suppose. So talking about arm's length income now, and specifically the interaction with capital gains tax provisions. So the ATO issued a draft tax determination 2023/TD1, which basically is how non-arm's length income and capital gains tax provisions sort of work together. Now, once again, this went out to industry consultation. Nothing's been finalised, so they're just really getting some feedback around it. So the theory here is that if a super fund undertakes a transaction, say it buys a property, and it didn't pay proper market value for it, so it might have paid $1 million when the property is worth, call it $1.5 million. That $500,000 is in theory a gnarly expense. Now, that $500,000, so that's 1/3 of the property. When the property is sold, say 10 years later, 1/3 of the capital gain at that time is now going to be a non-arm's length income event. So tax on that portion is paid on the property. In fact, it's the whole gain on the property, because the argument is that the fund would not have been able to have bought the property if it had conducted at an arm's length basis. So it's not just that proportion, it's the entire gain of the property. And as it's currently drafted, that any arm's length gains are also aggregated with non-arm's length gains. So it was always presumed, if you like, that you'd have your non-arm's length income gains in one pocket and your arm's length gains in another pocket, and they two didn't mix. But under the draft legislation, they actually do, which means that your gnarly gains contains your normal gains, so to speak. So it's important thing just to bear in mind that, once again, all transactions have to happen at arm's length, and that they and you need to make sure you've got substance for it, because otherwise the taxman will come a-calling looking for their non-arm's length income. Property development. So the ATO has issued a taxpayer alert, TA 2023, that should be 23, sorry, /2. So this deals with diverting of profits of a property development project through a SMSF, through what they call a special purpose vehicle, so a unit trust typically, involving non-arm's length arrangements. So in this alert is basically where there was an arrangement that involved a self-managed super fund investing, normally directly or normally directly into a unit trust. So it buys units in the unit trust, which then undertakes a property development. Now, the ATO views any non-arm's length dealings by that unit trust, in this case, in respect of any step, so the purchase, the development itself, whatever it might be, can give rise to gnarly. So just because you do it not in the fund but via a interposed entity, if you like, gnarly can still apply. So even though the gain might not be the super fund's gain in theory, because the unit trust is the one that's done the transaction and done the development and what have you, the ATO's view is that unless everything is done on an arm's length basis inside that property development trust, that special purpose vehicle, then if it's not done properly there, the super fund has to wear the tax consequences of NALI. Now, one thing to also bear in mind too, just around that, is that if you're doing property development, it might be that you've got problems with different areas of the superannuation law as well. So only certain types of trusts and certain structures of individuals involved can actually do true property development within inside a third party or not unrelated, within inside this unit trust or this special purpose vehicle. The reason for that is that there's a regulation that's called 13.22C, and it actually prohibits that trust or that entity from carrying on a business. So if you're doing a property development, potentially you're carrying on a business, which then means that you may actually fall foul of that area as well. So lots of twists and turns, if you like, when it comes to doing property development inside self-managed super funds, or even using super as part of the development. So it's always best to ask the question of your advisor first before actually doing anything, because it can cost you a lot of money if you get it wrong. So deductibility of personal super contributions. This is really just a little bit of housekeeping. There's nothing really much to it at all. So last year, they actually moved the work test for individuals from the super law to the tax law. But when they did that, it actually affected some people in relation to their ability to claim personal superannuation contributions. So what this tax administration determination does is it just sort of fixes that up and tidies that up. So it resolves the unintended consequences that impacted those aged between 67 and 75 who relied on the extended definition of employee under the SIS Act to be able to claim a deduction for their personal contributions. So, and as I've mentioned there, so in 1 July 22, when they moved it from being part of the SIS Act to the Tax Act, that sort of complication arose. So they're just really fixing that. So basically, you don't need to satisfy, you can rely on the extended definition of employee, so director of a company for argument's sake, between age 67 and 75. Now just talk about a couple of cases that have been kicking around of late. Once again, this one also relates to personal super contributions, but where it was disallowed. So these are this is an AAT case, so Administrative Appeals Tribunal case, where basically the taxpayer takes or disputes a decision that the ATO has made. So it's not a full court, but it's similar. It's a bit more less intense, I suppose, is the best way to put it. So in this particular case, during the 21 year, a taxpayer made personal super contributions to his super fund of $6,500. In early June 21, before making his last contribution of $550, he submitted a notice, which is called a 290-170 Notice of Intent to Claim form, advising his super fund that he wanted to actually make a tax deduction claim of $6,500. However, the super fund, while they acknowledged receipt of the notice, said it was unable to accept it because it only received $6,000 at that time. So the taxpayer then redid his notice. So we're up to notice number 2, but he posted this one in, saying he only wished to claim a tax deduction of $6,000 because that's what the super fund had said they'd received. He then went to lodge his personal tax return for 2021 on the 14th of July. However, because the super fund hadn't reported an acknowledgement of that notice, the ATO actually disallowed the deduction because it said, well, we don't know about it. So, and that's because the super fund didn't receive it. So then the taxpayer submitted a third notice in September 22. So no doubt that's why he's been going through the argy-bargies with the ATO. But they actually said that that was not valid because he'd already lodged his tax return, because the criteria around these notices is that the notice has to be provided to the super fund, and the super fund has to acknowledge receipt of the notice and provide that to you. You have to provide the notice to the super fund within 12 months or prior to you lodging your tax return. And you have to receive the notice prior to you lodging your tax return. So hence why this poor guy sort of failed on the 3 levels. First one was rejected because it was wrong. The second one, the super fund didn't receive it and meant that they couldn't obviously then send an acknowledgement of receipt and that it was valid. Then he lodged his tax return. And then the third one, he lodged after his tax return. So yes, he was up against the breeze, if I can put it that way. So I suppose the learning out of that is that timing is really important and getting it right, and waiting for that acknowledgement is important too, sorry. Now, this is an interesting case because it sort of dovetails into the gnarly discussion we were having before, and also around property development that we're having before. So while this isn't a property development case, it does impact on super funds with gnarly and related entities. So in this case, the super fund had invested in a unit trust and it received income from this unit trust. It was a beneficiary, obviously, and owned 100% of the units in this trust. That trust then loaned money to several related entities. And then from there, those related entities on-lent the money to independent and unrelated entities. So the key issue here was whether the amount of income is more than the amount that the entities would have otherwise expected to have derived had those parties been dealing with each other on an arm's length. So that's the definition of gnarly. If the super fund invests in something and it derives more income than would have otherwise done had it been dealing with arm's length, then it gnarly applies. That's the basic rule. Now, in this case, the tribunal held that the scheme established under the private lending facility did not differ from that which might have been expected to have operated between independent parties dealing independently with one another in the private lending market at the time. So in other words, because the super fund gave money to the unit trust then gave money to related people, the related entities then gave money to unrelateds. Because the related entities and the unrelated people were dealing with each other on an arm's length basis, what then flowed back from the related entities inside the trust, from the trust to the super fund, was deemed to be arm's length because everything flowed through. So essentially, it was as if the super fund had done the lending to these unrelated people directly on an arm's length basis. That was the net result of the income flow and also as the tribunal saw it. So the reason why this case is interesting is that the taxpayer was seeking to take the ATO to court, and this by the AAT saying that yes, you can appeal the ATO's decision. So there's likely to be more to run on this, and we'll see if it actually goes to court or whether the ATO just settled based on what the tribunal said. We'll find out in time. But it's an interesting case because it, I suppose, helps clarify when related entity or when unrelated entities and transactions, they can flow through related entities. But it's something that needs to be done very carefully because, once again, there are different areas of the SIS Act that can trip you up if it's not done properly. So, for argument's sake, inside this example, if you were to set up this structure today, that actually you'd need more than just the one self-managed super fund involved in it, because that unit trust would be deemed a related trust, which, once again, that 1322C section I mentioned before means you can't actually lend money to anyone. So it would fail on that one. Now, just briefly, just some stats, just for a bit of fun, because, you know, why not? These figures as at March 2023, that we haven't seen the June ones yet, or at least I haven't. But in March 2023, total self-managed super funds were at 606,217. Total members being 1.136 million. So that's an average of about 1.84 members per fund. 53% are male, 47% female, and 87% of all self-managed super fund members are older than 45. There's currently about $889 billion inside self-managed funds. I would suspect that's now above 900 billion now. And 26% of those are in listed shares. And from memory, it was 13% that are sitting in cash. So obviously all the other asset classes then flow out from there. So just something I thought was a little bit different, a little bit interesting. That's all. And then finally, I just wanted to, I suppose, mention about the $3 million tax, just because I know that obviously a lot of people are thinking about it and talking about it. Where are we at? Great question. We, as an industry, we're expecting to see draft legislation basically last month or this month. So far, there has been nothing. There's not going to be a lot of sitting days between now and the end of the financial year for anything that may arise to actually be passed this year anyway. And the government did say that they would go to a consultation process first. We'll see. Hopefully they will. They did do a little bit of consultation over Easter, and we haven't really heard anything from that. Now, because, and I suppose I'm sort of hearing rumours that it all might be a little bit hard for the government to draft what they're wanting to achieve, and particularly it might be a bit more difficult for the APRA funds in some areas as well. So it'll be interesting to see how this plays out and whether they try and attack it from a different way. So this measure was meant to raise about $3 billion worth of tax. Interestingly, if they remove the exemption of pension income from being non-taxed, so currently pension income is non-exempt income. So if they remove the deduction for asset supporting pensions, it's going to raise about $3.5 billion, between $3 to $5 billion. So it sort of raises a similar amount. So whether that might be something they look at, obviously it's very easy to do because we just don't apply for actuarial certificates anymore, and they just remove that that exemption from the income. So we'll see what happens. But basically, no news at the moment around this new proposed tax. So it's a wait and see. And with that, I'm pretty much finished. So I don't believe there's any other questions to flow through. If there's something that pops up that you have a a burning desire to know, by all means, please reach out. My contact details were at the beginning of the presentation, or just reach out to the Vincent's website and you'll find me under the experts on there. So if there's nothing else, have a great day, and we'll see you next time. Thanks very much.